Hi everyone, this is jchaconmolina with Weichert Realtors.
And I'm not.
No, you're not. You're with Weichert Financial. And your name is Christopher Caponiti.
It is.
And we're here to ask Chris a few questions about buying a home. Chris, hi.
Hi.
How are you?
All right.
So, if someone decides to purchase a home either now or in the near future and they want to see a lender, what documents should they bring?
Okay. Almost everybody, most people do receive pay stubs. I mean, not everybody. There are some people that are self-employed, but if you receive pay stubs, I would need your latest 3 pay stubs and then a copy of your latest 2 years W-2s or 1099s. If it's a 1099, I would also need your tax returns for 2 years, all schedules. If you are truly self-employed, then I would need your tax returns as well. Then I would need documentation of funds. So depending on what your down payment is, it could be 3%, it could be 5%, it could be 20%, whatever it is, I need to see 2 months history of that money. So that would be the form of, it doesn't matter what the statement is. It could be a 401k statement, it can be a savings account, it can be investment if you're gonna liquidate. Whatever it is, I need to see 60-day history of that money in the form of statements, all pages for 2 months. Finally, I would need your driver's license. Beyond that, it varies from case to case.
So can someone send this to you electronically as well? Do you need to meet face-to-face with them?
I like meeting face-to-face, but there are ways to send I have a portal that you can upload all the documents. You can actually fill out an application yourself and upload the documents. I tend to take most of my applications in person because I like doing it and because it gives me a familiarity with somebody's situation rather than just all of a sudden seeing some numbers and a name and a W-2 or whatever it is that someone uploads. I like to be able to talk to the person, ask them the questions I need to ask, and then of course it's on my memory forever, and I will never forget.
Well, that's good. At least you have options. So hopefully, if they send it to you electronically, then they can schedule a meeting with you, meet you face to face.
We have lots of options. I've never actually had a fist fight with a client before. So
well, that's good to know.
Yep.
That's good. You're very personable.
Yeah,
that's
yeah.
Good. So, if someone wanted to know how much they could afford on a house, what would you suggest?
Well, generally, it's calculated the same way by any lender. The programs vary slightly, but basically you have what's called a debt-to-income ratio. And that is your total expenditures in a month, including your home and all associated costs, including, let's call those insurance, your HOA fee, your condo fee, your tax bill, everything associated with that house, plus any other monthly bills you have, cannot be more than a certain ratio, meaning ratio of your gross monthly income. So if all your expenditures in your home are $3,000 and your income is $6,000, that would be a 50% DTI ratio. There are many programs that go to a 50 ratio. First-time homebuyer programs are 45 and 50 depending on the type.
Okay. So you wouldn't recommend someone buying a brand new car as soon as they think about buying a house?
Yeah, definitely not. Definitely don't go to Bob's Discount Furniture and buy a house load of furniture before the house is actually settled. Once you get a clear to close on a file, it's probably safe. Once you get an actual clear to close, not an approval, but a clear to close, it's probably safe to go out and go to Bob's Furniture and get a whole house load of furniture. But until then, definitely not. Don't buy a car, don't buy anything until you know what your situation is. I might tell you, don't worry about it. Buy a Range Rover. But until I see your stuff, I don't want to say anything until I've seen it.
So aside from the debt to income ratio, there's a little bit of a credit that plays into there.
Credit is very important. Credit is the singular most important item that determines your rate. Until recently, I only went to a 620 credit score. We've just introduced a program that goes down to a 580. However, first-time homebuyer programs are stricter. They have stricter requirements, they have income limits, and they have credit score floors. And generally at 640 or 660, depending on the type of the program that you're doing, where, again, I already said I can go to 580. The programs will only go to 640. There's nothing below a 640 in a first-time homebuyer program.
Okay. So, Chris, also, what is the difference between an FHA and conventional loan?
An FHA loan is a low down payment loan that is insured by the federal government. It does not have the traditional tiers, credit tiers that a conventional loan has. So as your credit score goes up, you would get a better rate or better terms With an FHA loan, everybody's in the same tier. So generally, it's going to be, maybe you've had a couple of credit issues in the past, and you have 3.5% to put down. Most likely, FHA is going to be the best option for you, but that really can be determined by your lender. The rules are slightly different for the two programs. So if your score is 700 or below and you have a low down payment, you're probably going to lean towards FHA. If you're above 700 and 720, it's probably a toss-up. I would give you both options. If you're over 720, you're probably a conventional buyer.
Okay, well, thank you for that. And so if you're a first-time home buyer in the state of Maryland, what benefits are there?
Well, there's a couple different definitions of first-time home buyer in the state of Maryland. A first-time home buyer, when it comes to transfer tax, you don't pay Maryland state transfer tax if you're a first-time Maryland home buyer. That definition is you've never bought a home in the state of Maryland at any time, ever. For the first-time home buyer programs in the state of Maryland, including the Montgomery County program, which is under HOC, a first-time home buyer is defined as somebody who has not been on title to a home for the past 3 years. So that's a lot of people that probably don't know they're qualified for a first-time home buyer program that in fact are. And I run into these people all the time. There could be any number of reasons why, but they're currently not on a title to a home and have not been on title to a home for the past 3 years. You qualify for all the benefits of a first-time home buyer. However, if you went to buy a home in the state of Maryland, you would not be exempt from that tax that we just spoke of before.
Okay. And so you touched a little bit on that, but what are closing costs?
Closing costs, first of all, you've got lender fees, and lender fees are pretty standard, but let's say about $1,000 for lender fees. And there's a processing fee, there's a commitment fee, everybody calls it something different. Then you have your credit report fee, you have your appraisal fee, then you get into other third-party charges, such as the attorney. You got a settlement fee, you have title insurance. These are all things that you'll learn about through the process if you don't know what they are. Title insurance, settlement fee, then you have escrow that you have to cover, which is prepaid taxes and insurance for the property. And that varies from jurisdiction to jurisdiction, but generally you're going to prepay an entire year's insurance, then you're going to pay about 9 months in escrow for taxes.
And there's also some state taxes, recordation, and transfer taxes you have to pay, correct? They paid settlement?
Absolutely. So that's the final item. And those will vary depending on whether or not you're a first-time home buyer in the state of Maryland. Those people don't have to pay a state transfer. You pay a recordation tax and you pay a county transfer tax. And those are going to be generally, again, the lower the price, the lower the percentage. The higher, in this case, it's the opposite. The higher the price, the higher the percentage. Okay, so you're basically looking at a little over 1%. That's a general rule.
So in total, it's like 3 to 4% of the sales price that you're paying, depending on the property.
I think that's fair.
Okay. So Chris, what first-time home buyer programs are there?
There are two primarily that I'm involved with. The first one is a Montgomery County program that's under HOC, Housing Opportunities Commission. There are two types. There is an FHA loan, an FHA program, which has a 660 credit score floor, and then there is a conventional program that has a 640 score. You can choose to do either a preferred rate, which is a below market rate, or you can choose to get closing costs and or down payment assistance. So what that means is if you take the assistance, there is a catch. The catch is your rate is higher. You would take a rate that's probably 3/4 of a point higher, and they would give you 3% towards the down payment, and then they would forgive that loan at the end of the 5 years. The only catch is that you still have the rate. So once you've basically paid back the loan through a higher rate, you are stuck with the rate indefinitely, unless the market rates drop, and you can then refinance. There's another program that we have that I take part in, that's the Maryland Mortgage Program, and this is a similar program. The major difference is that if you are a veteran, you can also take part in this program. They have a VA part of it where anybody that has military experience or presently or in their background can get a 0 down payment loan with no mortgage insurance. That's basically the biggest selling point of a VA loan. It's the best loan around if you qualify. And that also, there's a preferred rate, which is a below regular market rate, or two forms of assistance. One is the form of a 3% grant, which is payable in the future with no interest and no payments in the meantime, basically on today's dollars, okay? Or a 4% program, which raises your rate about an entire percentage point, and it is a grant, so it is forgiven in exchange for the higher rate.
So what do you mean by payable in the future?
So if somebody was to give you $10,000 today and say, when you sell your home in 15 years, you have to pay me back the same $10,000.
Okay. And also, when do you think that someone should speak to a lender if they're thinking about purchasing?
So you want to talk to a lender as soon as you can, because you don't know what your situation is. There are ways to, again, especially if you have credit issues, there are sometimes ways to get your credit score up to meet the requirements of a first-time program, or again, a repeat buyer program. The first-time home buyer programs actually have stricter requirements. So if there's a way to get your credit score up, you want to know in advance so that you have a few months to try to take care of what you need to take care of. There's lots of ways to do it.
And sometimes people don't realize how their credit affects their ability to purchase a
Credit
home.
is so important. Credit is really, as far as when it comes to rate, it's really the main driver. Putting down 5% or 20% is not going to change your rate, but having a higher credit score will. So it's a big deal.
Okay. Well, thank you very much, Chris. I appreciate your time. Thank you for answering a few of our questions. And if you have any other questions, feel free to give me a call at 240-351-4788, and I'll be sure to put you in touch with Chris. Thank you.
Thank you.